Welcome to Chapter 12, Macroeconomic and Industry Analysis. In the last two chapters, we spent a lot of time on bonds, yields, duration, and the mechanics of managing interest rate risk. Now we widen the camera. A security does not float in space. It lives inside an economy and industry, a policy regime, a currency system, and a business cycle. Those forces can change both the cash flows an investor expects and the discount rate used to value them. This chapter is about translating big economic variables into investment consequences. Growth affects demand, inflation affects costs, pricing power, and interest rates. Monetary policy changes financing conditions. Fiscal policy can support or crowd out private activity. Exchange rates can help exporters hurt importers and change the dollar value of foreign earnings. Industry structure then determines which companies can pass through costs, protect margins, or survive a downturn. The challenge is that macroeconomic analysis is useful and dangerous at the same time. It is useful because companies clearly respond to the economy. It is dangerous because the market is already trying to price the same information. A correct forecast can still produce a poor investment if the forecast was already embedded in the price. The economy can improve while a stock falls because investors expected an even stronger recovery. The economy can look terrible while a stock rises because the bad news was already priced in. Markets grade on expectations, not on whether the headline sounds cheerful. Recent history provides several clean examples. In 2020, the pandemic created both a demand shock and a supply shock. Travel and in-person services collapsed, while demand for cloud software, home improvement, and certain consumer goods surged. In 2021 and 2022, supply constraints, labor shortages, and strong demand pushed inflation higher. As central banks tightened policy, long-duration growth stocks were repriced even when many of the underlying businesses remained healthy. The companies did not suddenly forget how to sell software. The discount rate simply stopped being background music. We will study the global economy, the domestic macroeconomy, interest rates, demand and supply shocks, government policy, business cycles, and industry structure. The purpose is not to turn everyone into a television economist who predicts the next decimal point in GDP. The purpose is to build a disciplined process for asking, what changed? Which cash flows are exposed? Which discount rates are moving? Which industries have pricing power, operating leverage, or financial leverage? And what has the market already priced in? Macroeconomics is the weather system. Industry analysis tells us which businesses brought an umbrella, which built a roof, and which are standing outside selling sunglasses. This chapter has 4 practical learning objectives. First, you should be able to explain how global and domestic macro variables affect industries and securities. That means moving beyond statements such as inflation is bad or growth is good. Inflation can hurt a company with weak pricing power and high input costs, while helping another company whose revenue rises with nominal prices. A stronger domestic currency may lower import costs but reduce the translated value of foreign earnings. The same variable can create winners and losers. Second, you should be able to analyze the fundamental drivers of interest rates, along with demand shocks, supply shocks, and government policy. Interest rates reflect the supply of savings, the demand for borrowing, expected inflation, central bank policy, and risk premiums. A demand shock changes spending. A supply shock changes productive capacity or input cost. Fiscal policy works through taxes and government spending. Monetary policy works through financial conditions, credit, liquidity, and expectations. Supply-side policy aims at the economy's productive capacity. These categories overlap in practice, so the analyst must focus on the transmission mechanism rather than the label. Third, you should be able to interpret business cycles and economic indicators. An expansion, peak, contraction, trough, and recovery are not just boxes on a diagram. They affect revenue growth, credit losses, inventory, capital spending, employment, and investor risk appetite. The leading indicators tend to turn before the broader economy. Coincident indicators move with current activity. Lagging indicators confirm what has already happened. The distinction matters because markets often move before the economic data look comfortable. By the time every lagging indicator says the recession is over, the market may have been celebrating for months. Fourth, you should be able to apply industry analysis using cyclicality, operating leverage, financial leverage, and competitive structure. Operating leverage describes how fixed operating costs can magnify changes in profit when revenue moves. Financial leverage adds debt obligations to the equation. Competitive structure determines pricing power, entry barriers, substitution, and the ability to defend returns on capital. Two firms in the same industry can respond very differently because one has a flexible cost structure and a strong balance sheet, while the other has fixed costs, heavy debt, and very little room for error. The assessment focus is application, interpretation, and judgment. A strong answer identifies the macro variable, traces the mechanism into revenue, margins or the discount rate, and then names the remaining uncertainty. It should also ask what is already priced in. A weak answer merely repeats a definition or assumes that every company in an industry responds identically. The goal is not to become certain. The goal is to become organized. Macroeconomic certainty is usually most available after the trade would have been useful. The chapter is organized around 4 connected questions. Question 1 is the global economy. Companies sell, source, borrow, manufacture, and compete across borders. Regional growth rates differ. Currencies move. Commodity prices shift. Trade policy changes. A U.S. company can report strong unit demand abroad and still show weaker dollar revenue if foreign currencies decline. A domestic manufacturer can benefit from a weaker dollar through export competitiveness while paying more for imported components. Global analysis is not an optional appendix for multinational firms. It is part of the income statement. Question 2 is the domestic macroeconomy. We examine GDP, unemployment, inflation, interest rates, budget deficits, and sentiment. Each indicator answers a different question. GDP measures production. Unemployment describes labor market slack, but it often turns after the cycle has already changed. Inflation affects purchasing power, wages, input costs, and policy. Interest rates influence borrowing cost and present value. Deficits change the government's demand for funds and can alter the composition of economic activity. Sentiment can affect spending and investment, but mood is not the same as cash flow. Question 3 is the business cycle. Expansion, peak, contraction, trough, and recovery provide a useful framework, but real cycles do not arrive with a label and a bell. Different parts of the economy turn at different times. Housing can weaken before employment. New orders can fall before production. Credit spreads can widen before defaults rise. Markets often anticipate the cycle, which is why waiting for official confirmation can be expensive. The stock market is not the economy, but it is a voting machine on future economic profits. Question 4 is industry analysis. We classify industries, examine cyclicality, and study operating and financial leverage. We also consider competitive forces. An industry can enjoy rapid demand growth and still destroy shareholder value if competition is intense, capital requirements are high, and customers capture most of the benefit. Conversely, a slow growth industry can be attractive when entry barriers are strong, pricing is disciplined, and cash generation is reliable. These 4 questions connect in sequence. Global and domestic conditions shape the cycle. The cycle affects industry demand and cost. Industry structure determines how much of that environment reaches company profits. Valuation then tells us whether the expected outcome is already in the price. A useful habit is to separate the economic story from the investment story. The economy will grow is an economic statement. This company will earn more than the market expects, and the valuation does not already assume it, is an investment thesis. The goal is a usable mental model, not a vocabulary list. Macro analysis without industry translation becomes commentary. Industry analysis without valuation becomes a business school case. Investment analysis needs both, plus a price. This slide collects 6 core concepts. Each becomes useful only when we connect it to a decision. GDP is the market value of goods and services produced over a period. Analysts often focus on real GDP because it adjusts for changes in the general price level. GDP can help frame overall demand, but it is not a direct forecast of stock returns. Equity markets discount future profits, not the current quarter's national income report. A country can post strong growth while its stock market struggles if valuations were already high, corporate profits lag GDP, or the growth flows to industries that are not well represented in the index. Inflation is the rate at which the general price level rises. For investors, the important questions are where inflation comes from, whether it is persistent, and who has pricing power. A restaurant facing higher wages and food costs may struggle if customers resist menu price increases. A commodity producer may benefit from higher selling prices. A regulated utility may eventually recover costs, but only through a regulatory process and often with a delay. Inflation is not one uniform tax on every business. It is a negotiation over who absorbs the cost. A demand shock changes demand for goods and services. Tax rebates, fiscal stimulus, a collapse in confidence, a housing boom, or a sudden change in consumer behavior can shift spending. During the early pandemic, demand disappeared for air travel and surged for home delivery and remote work tools. Same economy, radically different income statements. A supply shock changes productive capacity or cost. Oil disruptions, natural disasters, war, port closures, labor shortages, and semiconductor constraints can reduce supply or raise input prices. The 1970s oil shocks are the textbook example. More recently, supply chain disruptions showed that a missing low-cost component can stop the sale of a high-value finished product. The cheapest part in the machine can become the most expensive problem. A cyclical industry has above-average sensitivity to the economy. Autos, construction, travel, capital goods, and luxury spending often respond strongly to income, credit, and confidence. A defensive industry has below-average sensitivity because demand is more stable. Utilities, consumer staples, and parts of healthcare are common examples. Defensive does not mean risk-free. A utility can be hurt by rising rates, regulatory decisions, storm costs, or heavy capital needs. A healthcare company can face patent, reimbursement, or political risk. Defensive refers to economic sensitivity, not invincibility. A strong answer names the concept, explains the mechanism, identifies the likely beneficiary and loser, and states what evidence would confirm the view. A definition is the beginning of analysis, not the victory lap. This slide turns the chapter into a 6-step top-down analysis process. Step 1 is the macro view. Assess growth, inflation, interest rates, policy, currency, and sentiment. Do not collect indicators like souvenirs. Identify which variables matter for the security under review. A home builder is highly sensitive to mortgage rates, credit availability, land cost, and household formation. A global consumer products company may care more about currency translation, commodity inputs, and emerging market demand. Step 2 is the cycle position. Decide whether the economy appears to be in expansion, peak, contraction, trough, or recovery. The label will never be perfectly certain. Use multiple indicators, not one heroic forecast. New orders, unemployment claims, building permits, credit spreads, inventories, and the yield curve can provide different pieces of the picture. The best conclusion may be a range of plausible cycle states rather than a single confident word. Step 3 is the industry screen. Identify cyclical exposure, operating leverage, financial leverage, and competitive forces. Ask whether demand is discretionary or recurring. Are costs mostly fixed or variable? Does the industry require continuous refinancing? Can firms pass through higher costs? Is capacity disciplined? Or does every period of strong pricing attract a wave of new supply? Step 4 is company fit. Compare the firm's strategy and financial condition with the industry environment. One airline may have a stronger balance sheet, a better route network, and more fuel hedging than another. One software company may have mission-critical recurring revenue and strong free cash flow, while another depends on cheap capital and customer growth that never reaches profitability. Industry averages are useful, company specifics pay the bills. Step 5 is valuation. Translate the environment into explicit assumptions for revenue, margin, capital spending, working capital, and discount rates. Higher rates can reduce value directly through the discount rate and indirectly through weaker demand or higher financing expense. A lower multiple may be justified, but a lower multiple alone does not tell us the stock is cheap. Sometimes the denominator is about to become smaller. Step 6 is risk review. Stress alternative scenarios. What happens if inflation stays high? If the central bank eases because growth collapses rather than because inflation is conquered? If the currency moves 10%? If the industry enters a price war? The purpose of stress testing is not to predict every future. It is to find the assumptions capable of breaking the thesis. Process discipline prevents macro analysis from becoming storytelling. A clever economic narrative can explain almost anything after the fact. A useful investment process states the mechanism, the evidence, the valuation, and the conditions that would prove it wrong. The world's best macro call cannot rescue the wrong security at the wrong price. It can, however, make the postmortem extremely articulate. The key relationship on this slide is simple but powerful. Firm value depends on expected cash flows and the discount rate, and macro conditions can move both. Start with cash flows. GDP growth, consumer demand, business investment, employment, input costs, and the industry cycle affect revenue and margins. A stronger economy can lift volume, but the benefit depends on capacity and competition. If every firm adds capacity at the same time, revenue may grow while returns on capital disappoint. If demand rises in an industry with limited supply and strong pricing power, margins can expand rapidly. Now consider the discount rate. Interest rates affect the present value of future cash flows. The further those cash flows lie in the future, the more sensitive valuation can be. This is why high-growth companies are often described as long-duration equities. When rates rise, the mathematical present value of distant profits falls, all else equal. In 2022, many growth stocks experienced sharp multiple compression even when their revenue continued to rise. The business result and the stock result were not the same sentence. Risk premiums also matter. During periods of fear, investors may demand more compensation for equity, credit, liquidity, or country risk. A company can face no change in its expected operating cash flows and still lose value because the required return rises. During a recovery, the reverse can happen. Profits remain weak, but risk premiums fall, and valuations rise before the income statement looks healthy. Currency adds another layer. A stronger home currency can reduce the translated value of foreign revenue. It may also lower imported input costs. A weaker currency can support exporters while increasing the price of imported energy, components, or debt service. The net effect depends on where the company sells, produces, borrows, and hedges. Policy can influence both sides of valuation. Fiscal spending can boost demand for construction, defense, healthcare, or infrastructure. Taxes can change after tax cash flows and incentives. Monetary policy affects rates, credit, and risk appetite. Supply-side policies can alter labor participation, investment, productivity, and capacity over longer horizons. The analytical discipline is to trace the arrows. Do not say, rates are up, therefore stocks are down. Ask which rate, why it moved, what happened to expected cash flows, what happened to the required return, and what the current price already assumes. Banks, utilities, software companies, home builders, and insurers can all respond differently to the same rate move. The formula is not difficult. The difficult part is deciding which inputs actually changed. Finance rarely hides the judgment. It simply places the judgment immediately before the equal sign. This slide compares cyclical and defensive industries. Cyclical industries have above average sensitivity to the business cycle. Demand often rises quickly during expansion and falls sharply during contraction. Autos, housing, construction materials, airlines, capital equipment, luxury goods, and advertising are common examples. These industries may also carry substantial operating leverage. When volume rises, fixed costs are spread across more units, and profit can grow faster than revenue. When volume falls, the same fixed cost structure works in reverse. Consider an airline. Aircraft leases, labor, airport facilities, and many operating costs do not disappear because one flight has fewer passengers. A modest decline in ticket revenue can create a much larger decline in operating profit. Add financial leverage, and the equity becomes even more sensitive. Airlines can produce spectacular recoveries and equally spectacular reminders that fixed costs do not have feelings. Defensive industries have more stable demand. Consumers continue to buy food, household products, electricity, and medical services, even when the economy slows. That stability can reduce earnings cyclicality. But defensive does not mean the stock price will be stable in every environment. Utilities are often capital intensive and rate sensitive. Consumer staples companies can suffer when commodity and labor costs rise faster than prices. Healthcare firms face regulation, reimbursement, product, and litigation risk. The distinction is also not permanent. An industry can become more or less cyclical as technology, contracts, customer behavior, and business models change. Subscription revenue can make some software businesses more resilient than traditional license models, yet software valuations can remain highly sensitive to interest rates because much of the expected value lies in distant cash flows. Stable revenue does not automatically mean stable valuation. Industry labels should be starting points. Within a cyclical industry, one firm may have a strong balance sheet, variable costs, and a low break-even point. Another may be highly leveraged and dependent on perfect capacity utilization. Within a defensive industry, one company may have pricing power and recurring demand, while another faces private label competition and margin pressure. The better choice depends on the job the investor needs done. A portfolio seeking downside resilience may favor defensive cash flows. A portfolio positioned for early recovery may seek selected cyclicals, but the investor must still consider valuation. A defensive stock priced for perfection can be more dangerous than a cyclical stock priced for disaster. The useful question is not which column is safer, it is what economic sensitivity am I buying, how much leverage amplifies it, and what price am I paying for the privilege. Modern macroeconomic analysis requires a wider dashboard than the old routine of checking GDP and the unemployment rate. Global supply chains matter because production is distributed across countries, suppliers, ports, and transportation networks. The pandemic revealed how quickly a disruption in one part of the system can change inventory, delivery time, and pricing across many industries. The semiconductor shortage did not remain a semiconductor story. It became an auto production story, a consumer electronics story, and an inflation story. Policy rates matter, but so do the reasons they move. A central bank raising rates because demand is strong creates a different environment from a central bank raising rates because inflation expectations are becoming unanchored. A rate cut can be positive if inflation is easing without a collapse in growth. It can be a warning if the cut responds to a financial crisis. The direction of policy is not the full message. The diagnosis behind the policy matters. Inflation expectations influence wages, contracts, borrowing, and valuation. Fiscal deficits can support current demand while increasing government borrowing and raising questions about future taxes, rates, or inflation. Exchange rates affect multinational revenue, import cost, commodity prices, and global capital flows. Geopolitical risk can change energy supply, trade routes, sanctions, defense spending, and access to markets. The practical task is translation. When oil prices rise, do not stop at energy benefits. Ask which producers have unhedged exposure, which refiners face different margins, which airlines face higher fuel cost, which consumers lose purchasing power, and whether the price move reflects supply loss or strong demand. The same oil chart can tell more than one economic story. Use the 4 questions on the slide. What changed? Identify the variable and the mechanism. Did demand rise? Did supply fall? Did the discount rate move? Did policy alter incentives? What stayed the same? Many durable features survive the headline. A company may still have a strong balance sheet, a weak competitive moat, or a recurring revenue model. Who benefits? Name the likely winners and losers. Avoid the phrase the market when the effects are clearly uneven. What risk remains? Ask what could reverse the outcome, what the market already expects, and whether the position can survive a different scenario. Modernization should not mean chasing every alert on a phone. It should mean using current information inside a durable analytical framework. Headlines are inputs. They are not a portfolio strategy. The market produces an unlimited supply of urgent news. Investment judgment is deciding which urgency deserves capital. Let us apply the framework to the practice case. Inflation is rising. The central bank tightens policy. Consumer confidence weakens. We are asked to evaluate airlines, utilities, software, and discount retailers. Pause for a moment and rank the 4 industries from most cyclical to least cyclical. Then identify one valuation effect and one operating effect for each. Start with airlines. Airlines are generally highly cyclical. Travel demand depends on employment, income, business activity, and confidence. The industry also carries substantial operating leverage because aircraft, labor, and airport costs are difficult to reduce instantly. Rising inflation can increase fuel and wage expense. Higher rates can raise financing cost, especially for leveraged carriers. If confidence weakens, discretionary travel may slow. The combination of weaker demand and fixed cost can compress profit rapidly. The trade-off is that airline stocks may already reflect a downturn, and capacity discipline or lower fuel prices could improve the outcome. Utilities are usually more defensive because electricity and gas demand are relatively stable. But utilities are capital intensive and often financed with substantial debt. Higher rates can increase borrowing cost and reduce the relative appeal of dividend yields. Regulation may allow cost recovery, but often with delay. Utilities may therefore have defensive cash flows and rate-sensitive valuations at the same time. Defensive operations are not the same as an interest rate hedge. Software requires more nuance. A mature software company with recurring mission-critical subscriptions and strong free cash flow may have resilient revenue. A speculative software company dependent on cheap capital and distant profitability may be economically and financially fragile. Higher discount rates reduce the present value of long-dated cash flows, so software valuations can fall even if current revenue remains steady. The label software is too broad to finish the analysis. Discount retailers may benefit when households trade down from premium stores. That can make the industry relatively defensive in a slowdown. However, margins can still be pressured by wages, freight, shrink, inventory mistakes, and aggressive competition. A discount retailer with strong purchasing power and inventory control may gain share. One with weak logistics may discover that low prices and low margins are uncomfortably close relatives. Now choose a leading indicator to monitor. Initial unemployment claims can provide an early signal of labor market deterioration. New orders can signal changes in production. Building permits can help with housing-related activity. For this case, initial claims and consumer-related new orders would be useful, but no single indicator should carry the entire forecast. Finally, explain operating leverage. Suppose an airline's revenue falls 5% while many costs remain fixed. Operating profit can fall by much more than 5%. The same mechanism can create rapid earnings growth during recovery. Operating leverage is a magnifier, not a direction. The direction comes from revenue. A strong response makes a recommendation, cites the macro mechanism, distinguishes cash flow effects from valuation effects, and states a trade-off. The best answer may conclude that utilities and selected discount retailers have more defensive demand, while airlines are more cyclical, and software requires firm-level separation. Macro analysis should narrow the questions. It should not erase the need to read the company financials. This slide highlights 5 common mistakes. Mistake 1 is forecasting one macro variable and ignoring what the market already priced. An investor may correctly predict lower inflation, stronger GDP, or a rate cut, and still lose money because the consensus expected an even larger change. Investment returns depend on the gap between outcome and expectation, not simply the direction of the headline. Mistake 2 is treating GDP growth as identical to stock returns. GDP measures economic production. A stock index reflects the present value of future corporate profits for the companies included in that index. The sector mix, profit share, global exposure, valuation, and discount rate all matter. The fastest growing economy does not automatically have the best performing stock market. If it did, international allocation would be a very short spreadsheet. Mistake 3 is ignoring exchange rates for global companies. Revenue can be earned in one currency, costs paid in another, debt issued in a third, and financial statements reported in a fourth. Translation, transaction exposure, hedging, and competitive effects can all matter. A strong dollar may reduce reported foreign revenue but lower some imported costs. The net effect must be analyzed rather than guessed. Mistake 4 is confusing leading, coincident, and lagging indicators. Initial unemployment claims may turn before the unemployment rate. New orders may weaken before production. The unemployment rate can continue to rise after a recession has technically ended. Using a lagging indicator as a trading signal can result in beautifully confirmed history and very late positioning. Mistake 5 is applying industry averages without checking firm-specific leverage. 2 companies with identical revenue declines can produce very different equity outcomes because of fixed costs, debt, liquidity, hedges, and covenant structure. The industry tells us the neighborhood. The balance sheet tells us whether the house has a basement pump. There are additional traps. Do not assume a demand shock and a supply shock require the same policy response. Stimulating demand during a supply constraint can increase prices without restoring capacity. Do not assume rate cuts are always bullish. Sometimes rates fall because the economy is deteriorating faster than expected. Do not confuse a good company with a good stock or a bad economy with a guaranteed bear market. Most of all, avoid false precision. Macroeconomic data are revised, relationships change, policy operates with lags. A forecast of GDP to one decimal place can look scientific while resting on assumptions that would not survive a normal Tuesday. A disciplined analyst uses scenarios, ranges, and probabilities, and the objective is not to sound certain, it is to identify what matters, what is priced, and what would change the recommendation. Here is the knowledge check. Which type of industry has above average sensitivity to the state of the economy? A cyclical industry. B, a defensive industry. C, a risk-free industry. Or D, a tax-exempt industry. Pause for a moment and choose your answer. The correct answer is A, a cyclical industry. Cyclical industries tend to experience larger changes in demand, revenue, and profit as the economy expands and contracts. Autos, housing, travel, construction, and capital goods are common examples. Operating leverage can magnify the effect because fixed costs do not move one for one with revenue. Answer B is incorrect because defensive industries generally have below average sensitivity to the cycle. Demand for utilities, staples, and many healthcare services is usually more stable. Again, defensive does not mean risk-free. It describes economic sensitivity, not every source of investment risk. Answer C is not a real industry classification. No operating industry is risk-free. Even Treasury securities are exposed to inflation and interest rate risk when held before maturity. Answer D describes a tax feature, not business cycle sensitivity. Municipal bond income may receive tax advantages, but that says nothing about whether an industry is cyclical. The correct answer is A. The more important follow-up is how cyclical is the specific company after considering its cost structure, debt, customer mix, and valuation. Industry classification is a useful first pass. It is not permission to stop thinking. Let us close chapter 12 with 3 takeaways. First, macro analysis affects both expected cash flows and discount rates. Growth, inflation, employment, currency, policy, and shocks can change revenue, margins, financing cost, and risk premiums. The same macro variable can benefit one company and hurt another, so the mechanism must be explicit. Second, business cycle sensitivity differs across industries and firms. Cyclical industries tend to experience larger swings in demand and profit. Defensive industries tend to have more stable demand, but they can still carry rate, regulatory, commodity, valuation, or company-specific risk. Operating leverage magnifies changes in revenue. Financial leverage magnifies the effect on equity. Competitive structure determines whether firms can protect price and margins. Third, industry analysis connects big picture economics to firm valuation. A top-down process begins with the macro environment, identifies the cycle position, screens industries, studies company fit, translates the evidence into cash flow and discount rate assumptions, and stress tests alternative scenarios. The process should end with a valuation and a statement of what would prove the thesis wrong. After the slides, the homework asks you to complete the macro to industry investment brief. The discussion asks whether macro forecasts help investors. The quiz checks global and domestic variables, interest rates, shocks, policy, indicators, cycles, cyclicality, and leverage. Finish with the question on the slide. What would change my recommendation? Would a different inflation path change margins? Would a rate cut reflect improving inflation or collapsing demand? Would a stronger currency change translated earnings? Is the industry entering a new capacity cycle? Does the company have enough liquidity to survive a downturn? Is the valuation already assuming the optimistic case? Which leading indicator would provide early evidence that the thesis is wrong? Those questions turn macroeconomics from commentary into investment analysis. The next chapter moves into equity valuation. That transition is important. Macroeconomic and industry analysis gives us assumptions about growth, margins, risk, and discount rates. Equity valuation forces us to put numbers around those assumptions and compare estimated value with market price. The narrative meets the calculator. Remember the central lesson. A strong economy does not guarantee a strong investment, and a weak economy does not guarantee a poor one. Prices reflect expectations. The analyst's job is to connect the economic environment to company cash flows, industry structure, discount rates, and valuation more accurately than the market consensus. Macro forecasts are not crystal balls. At their best, they are stress tests with better vocabulary